Hello everyone, this is Madhvi Mehta from Kotak Securities Commodity Research Team and I'll be discussing the outlook for major non-agriculture commodities. Well, it was a week of respite for commodities. However, it is still early to say that we are out of woods. Trend in US dollar continues to be key price determining factor and demand supply factors have taken a backseat. Bloomberg Commodity Index ended modestly higher last week, marking its first rise in 6 weeks. Individually, gold slumped to March 2021 lows but recovered to end higher. Industrial metals also ended higher with nickel and aluminium leading the way. Crude oil ended little changed after 2 weeks of losses. Commodities recovered from the lows amid correction in the US dollar and amid some stability in the equity markets. The US dollar index ended lower after 3 weeks of gains and has corrected more than 2% from 2002 highs set earlier this month. Euro, British pound, Japanese yen all rose against the US dollar, reflecting a general correction in the US currency. In equity markets, US DJI index ended with robust gains, marking its second rise in 3 weeks and tested a 6 week high. European and Japanese equities also ended higher, reflecting a general shift towards equity market. Chinese equities also found some footing and ended higher, marking its first rise in 3 weeks. Amid safe havens, Japanese yen, Swiss franc, US Treasury bonds all rose last week while gold managed to recover and end higher. In the last few days, the general trend was to shun all asset classes and move to the safety of US dollar amid increasing growth worries and expectation that Fed may lead other central banks in monetary tightening. We saw some reversal in this trend last week as equities, commodities, and safe havens rose while the US dollar struggled. The US dollar has been on a rise since start of the year and saw substantial gains since start of the month as market players braced for the second half of the year. While there has been no major factor to dampen the outlook for US dollar, the sharp rise has made it vulnerable to profit taking, and this is what we saw last week. The US dollar lost some momentum as mixed US economic data highlighted increasing stress in the economy, which fueled expectation that Fed may take a more measured approach on monetary tightening. To name a few, US weekly jobless claims rose to the highest level in 8 months. Philadelphia Fed July Factory Index contracted for the second straight month in the month of July. Leading indicators index fell for the fourth straight month, adding to debate about a recession. On Friday, the services PMI reading came below 50, indicating a contraction in the sector. Monetary tightening stance of other central banks also caused market players to shift out of US dollar. ECB raised interest rate last week for the first time since 2011 and surprised market players with a direct 0.5% hike. ECB's sharp move reflects urgency to act to get inflation under control. However, ECB officials have indicated that future moves will be data dependent. The Japanese yen also found some footing even as Bank of Japan kept monetary policy unchanged and maintained support for accommodative monetary policy stance. While market players cheered the correction in US dollar and moved back to other asset classes, risk appetite continued to remain challenged by growth worries, monetary tightening by major central banks, and virus concerns in China. Economic data from major economies highlighted challenges to economic activity. Eurozone manufacturing and services PMI data disappointed, while UK consumer prices rose at the fastest pace in 40 years, and unemployment claims fell less than expectation. Downbeat growth forecast also highlighted increasing challenges. Amid the latest, Asian Development Bank lowered GDP growth forecast for developing Asia from 5.2% to 4.6%, citing China's adherence to zero COVID policy. Mixed corporate earning results also highlighted uncertainty. Meanwhile, companies are also slowing hiring amid growth worries. Bloomberg report last week noted that Apple plans to reduce hiring and spending in the year of 2023. China has continued to adhere strictly to zero COVID policy, and this has made market players concerned that economic activity may remain affected unless virus spread comes under control. Virus cases in China last week jumped to the highest level since May, and authorities have put millions under some form of restrictions. Along with COVID, market players are also worried about the quick spread of monkeypox. The World Health Organization has declared monkeypox a global health emergency. So far, more than 16,000 cases have been reported in 75 countries. Russia-Ukraine war also remains in focus. Risk sentiment improved last week as Russia resumed gas supply to Europe through the Nord Stream pipeline after completing maintenance work, easing worries about an energy crisis in the region. However, supply concerns may persist as Russian supply is still below normal levels and could be affected due to sanctions. Market sentiment got a boost also as Russia-Ukraine reached a deal to start grain exports from Ukraine. However, concerns rose again following Russian missile strike at the southern Ukrainian port of Odessa. Overall, there is still a lot of uncertainty in the market and volatility is likely to continue. Growth worries, tightening concerns, and China's virus strategy may continue to challenge risk appetite. However, near-term trend for commodities may continue to be determined by the US dollar. The US dollar is showing signs of exhaustion, but we need to see whether it will continue or not. The major event in the coming week is Fed's decision on July 27th. In last few weeks, market players have debated if Fed may continue with 75 basis point rate hike or consider an even bigger and unprecedented 1% hike at the upcoming meeting. Amid some dismal economic readings, cautious comments from some central bank officials, and some signs of easing in inflation expectations, market players are now expecting Fed to continue with 75 basis point rate hike. We have already seen a correction in the US dollar ahead of Fed decision. However, if the central bank raises interest rate at a similar pace, it may be seen as a sign that the central bank is pausing to assess impact of monetary tightening on economic growth. This may lead to some further correction in the US dollar. Also in focus will be the first estimate for second quarter GDP growth. There has been an increasing debate about recession in US and data will be watched for more clarity. Forecasts indicate that economy rose marginally after a contraction in the first quarter. A small but positive growth may be enough to revive some confidence in the US economy. Let us now start with individual commodities and we'll start with gold first. Gold slumped to March 2021 lows last week but recovered to end higher, marking its first rise in 6 weeks. Gold rose amid correction in US dollar and bond yields as market players assessed US economic health and Fed's monetary tightening stance. Recovery across commodities also lent support to gold. However, weighing on price were continuing ETF outflows, concerns about consumer demand in India and China, and monetary tightening by major central banks. Gold witnessed a sharp fall in last few weeks and we are now seeing some relief rally. However, we still do not expect a sustained rise as Fed is unlikely to waver from its monetary tightening stance with inflation still out of control. The trading range we see in the near term is 49,500 to 52,200. Moving to silver. Silver also shed losses and ended a little change for the week. Silver benefited from recovery in gold and industrial metals as US dollar eased back from highs while risk sentiment improved. ETF outflows, however, showed continuing exit by investors. Silver has also shown some signs of recovery. However, the general bias may remain on the downside unless we see pickup in investor activity. The trading range we see in the near term is 54,000 to 57,500. Moving to industrial metals, let's start with copper. Copper prices made a recovery last week, supported by softer US dollar and fresh measures by China to support its ailing real estate sector. Downward revision in output guidance by several mining giants also helped push prices higher. However, weighing on price was miners' demand concerns amid slowdown threats. Going ahead, copper may see some gains amid reduced expectation of an aggressive move by Fed. Market players may also position for key US economic data, which includes GDP growth estimate, core PCE index, etc. The trading range we see for the week is 600 to 670. Moving to aluminium. Aluminium prices gained steam this last week as Chinese regulators urged banks to increase lending to developers so they can complete unfinished housing projects, making an effort to provide a much-needed respite to the ailing real estate sector. This helped the metal reverse decline seen earlier in the week owing to increased production and reducing imports from China. International Aluminium Institute data showed that global primary aluminium output rose nearly 2% on the year in June, while China's aluminium imports fell 36.3%. After the gains last week, aluminium may trade slightly lower, weighed down by resumption of China's aluminium capacity and macroeconomic concerns. However, lower stocks at LME warehouses, which are near 22-year low, may provide some support to prices. The trading range we see for the week is 204 to 222. Next, let's discuss zinc. Zinc prices traded with a positive bias as European Union urged member states to cut gas usage by 15% until March. indicating restrained metal capacity in the region in the near term. Also, LME COT report showed speculators have increased their bullish bets to the most in 5 weeks. Going ahead, zinc may hold on to the gains amid expectation that falling Chinese steel stocks may prompt replenishment demand. As per reports, steel products held by traders decreased for a fifth consecutive week to reach a 5.5-month low. The trading range we see for zinc is 260 to 286. Lastly, let's talk about lead. Lead prices surged about 2000 level as power rationing limited output growth in China, coupled with a modest demand recovery in lead acid battery market. Despite the gains last week, we expect lead to weaken in the coming week on back of muted downstream demand, though lower stocks at both LME and Shanghai warehouses may keep prices supported. The trading range we see for the week is 167 to 184. Moving to energy complex, let's start with crude oil. NYMEX crude saw a firm start to the week but lost momentum close to $100 and ended the week little changed. Crude oil was volatile amid mixed factors and position squaring near expiry. Weighing on price was signs of weaker gasoline demand in US, forecast of higher US production, improved supply from Libya, easing concerns about European energy crisis, and some disappointing economic data from major economies. However, supporting price was correction in the US dollar index, gains in US equity market, sharp decline in US crude oil stocks, and concerns about Russian supply and no commitment from Saudi to raise output. Crude oil may remain volatile as both demand concerns and supply risks are unlikely to get resolved soon. However, we expect selling pressure to emerge at higher levels amid increasing challenges to US and global economy. The trading range we see for the week is 7,200 to 8,350. Lastly, let's talk about natural gas. Natural gas rose over 18% last week and tested the highest level since mid-June. Natural gas edged up, gaining support from robust cooling demand in US due to severe hot weather in some parts of the country. A smaller than expected rise in US gas stocks and drop in production also lent support to prices. However, weighing on price was improved Russian supply to European region and Europe's emphasis on voluntary reduction in gas consumption. Natural gas has continued to set fresh highs, which shows strong positive momentum. However, the pace of gains may slow down post-expiry as supply situation in US is improving amid reduced LNG exports. The trading range we see for the week is 560 to 710. Well, that's it from my end. I wish you all a very happy trading week. Thank you.